welcome to Moneycontrol. You have tuned into IPO Watch and I'm your host Nickey Mirchandani. We're here to talk about the initial public offering of popular vehicles and services, which is opened up for subscription on March 12, that's today. And it's going to be open till March 14. The auto dealer company has fixed the price band in the range of 280 to 295 per equity share. It's a book build issue and they're planning to raise roughly around 601 crore from the initial public offering. But to know more about the company's financials, strategies and the USP, we've been joined by the management here, the managing director Naveen Philip and the CFO, Mr. John Varghese. Well, afternoon there, gentlemen.
Afternoon, Nickey.
Okay, I'm going to start off with the very basic layout of what the company does. It's a leading diversified automobile dealership in terms of revenue, in terms of FY 2023 integrated model, and the company essentially operates in three key segments, that is passenger vehicle, commercial vehicle and electric two-wheeler and three-wheeler.
Sure.
Tell us more about your business, about your clients, about the business mode. Tell us all.
So we, as it's spread across 4 states, Kerala, Karnataka, Tamil Nadu and Maharashtra, and in the business of selling and servicing vehicles. Now we've sold approximately 60,000 vehicles last year, about 48,000 new vehicles and 12,000 pre-owned vehicles as such. But the focus area is service. We serviced close to 1 million vehicles last year, 950,000 odd vehicles. And that's about 20 times the multiple of the number of vehicles that we sold. And going forward, that is what we are focusing on in terms of service. So this year, first half, we have already crossed 5.2 lakhs vehicle service. So the service and the expansion of services are moot. And this sort of, so even though we sell only 48,000 vehicles, the servicing is 22 times.
Okay.
And that means we are taking vehicles for service from other dealerships or other manufacturers as such. So that's it.
All right. Talk more about your clients and how different is your, profile as compared to the peers, VST Motors, Landmark Cars, something like that. Tell us more about the USP of your company per se.
So our 2 largest OEMs and who we are associated with is Maruti Udyog Limited and Tata Motors Limited in passenger vehicles and commercial vehicles. Both these are the largest in terms of market share. And the car park that is already there. So about 41% market share is what Maruti holds today in terms of sales. But in terms of car park, the number of cars available for service is probably closer to 60-65%. Because over the years, over the 4 decades that we have been associated with Maruti, and Maruti has been there in India, the car park has been built up, and that's our focus area. Landmark or other peers, so Landmark is in the luxury car business, Popular is in the mass market in Maruti, and now today Maruti dominates the SUV segment also. So from a 5 lakh vehicle to a 25 lakh vehicle to actually a 40 lakh vehicle, is there from offering from Maruti. And that's the bulk of sales in India. The luxury car market is about 1%. We also do luxury vehicles through Jaguar Land Rover.
Right.
So our sale of Jaguar Land Rover vehicles is about 250 vehicles a year. So the large market and hence the service opportunity there is what we are focusing on. And I think India is a large enough market. We are today only at 4 million vehicles. Over the next probably 6-7 years, it will go to an 8 million vehicle market. US is 16 million vehicles. China is double of that. So an Indian population is about 25 cars per 1,000. The rest of the countries are at around 500. So the runway is too long. The market is huge enough for more than, I think, probably about 10-15 players to be large enough here.
Fair. All right. So capturing on the bigger size of the market and your association with something like Maruti Suzuki is one of the USPs, according to you, that cuts the edge for you. But let's talk more about the revenue contribution from the segments. 77% is derived from the dealership of Maruti, like you mentioned, Tata Motors and Honda. I mean, don't you think it's a little concentrated, or you think you can diversify more, or you think it's a very conscious strategy that the company has taken?
It's a very conscious strategy. As I said, our focus is on service. So if you look at the largest car park available is for Maruti Suzuki. And we would like to keep growing with that. So it's a very conscious strategy. And similarly in commercial vehicles, Tata Motors is the largest player in the commercial vehicle segment. So in both these segments, we would like to keep growing with those 2 large OEMs. And they've proven themselves over the last 40 years to 60 years that they are the market leaders.
Right.
And consistency, if you look at, say, a Wagoner from Maruti stable, it's been the market in the top 10 selling cars for the last 4 decades, or a Swift Desire, or a Baleno, or an Ertiga. So that's the sort of focus that we have, John.
Yeah, in fact, 7 out of 10 best selling models at any point of time for the last decade or more has been a Maruti model.
Right.
And that percolates to the fact that there are more vehicles for servicing. So it's a conscious decision to grow along with Maruti in the future too.
So I would just like to add here, 15% of our turnover comes from service, which is about 750 crores out of the 4,800 crores that we had last year. But 55% of our EBITDA comes from service. And if you take a flow through to PAT, it's close to about 80%. So that's how we're growing our service business. And service CAGR for the last 4 years, I think from 2019, has been growing at 25%.
Right.
So we were, pre-COVID, I think we were at a turnover of about 420 crores, which was about 10% of our turnover. Today we have 15% of our turnover at 750 crores and 55% of EBITDA, which was closer to about 45%, 46% earlier. So both in terms of turnover in services side and in terms of EBITDA margins, we've been consistently increasing.
All right. Let's talk about, so this is what it is in that case. Maruti, Tata Motors and Honda, these are going to be the constant out there. Let's talk about the new geographical area, Maharashtra market, which you've entered in FY 2023. Relatively newer market, let's just put it that way. Overall, how has the response been in that market from the industry standpoint, demand trends, scenes across categories of the segments that you have, which is doing really well? Are you seeing any supply chain constraints out there?
No supply chain constraints right now. A few models here and there, but otherwise no supply chain constraints. So every market that we enter, we be able to scale up much faster than most of our competitors.
Right.
So that's been our focus. When we entered Tamil Nadu, when we entered Maharashtra, all the markets. So I think the core strength of the group has been able to scale up at a much faster pace.
Just to add to what Naveen says, inorganic growth is something is been our strength.
Right.
And the example of Maharashtra is one such example. 1 year back when we took over, that time the average monthly sale was about 20 vehicles, trucks, Bharat-Benz trucks. Today as we speak, it's gone up to 60 per month. This is with the same manpower that was existing at that point of time. We have not changed the manpower that was there even before prior. It's only the management, reviews, systems, processes, SOPs, marketing skills that are brought in, which helped us in scaling up this. And as we speak, it is profitable too.
All right. That was exactly my next question, gentlemen. The company generally seeks to acquire in dealership with high growth automobile brands, even if it's outside the portfolio for that matter. How do you intend to now scale up further? Where the growth essentially will come in from? Will it be more by entering into different geographies? If yes, anything that you're targeting at this time?
I think we are not supposed to speak about the future much, but we've been our lips are sealed.
They're not financial projections.
But in terms of both, we would like to look at. So we study a market. So the growth markets, if you like Andhra, Telangana, we don't have a presence there. Gujarat, NCR. So these are areas that we would like to target as such, and our focus would be in terms of acquiring dealerships also.
Okay, and what kind of incremental revenue are you targeting from these geographies?
So I can't say the future figure for in the past. So when we acquired a Maruti dealership probably about 3 years ago.
Yes.
Which contributes now about 10% of our
of Maruti's revenues.
So over the years, if you look at over the last 7 to 8 years, the acquisitions that we have done contribute close to about 35-40% of our revenues.
Right.
So going forward,
and this will only scale up as we go forward.
Okay. All right. Let's talk about your margin profile. The operating margins have been at 4.5%. versus say a 7%, 5 to 7% being noticed by VST Motors, Sai Services, Landmark Cars. So there is a bit of difference when it comes to the other peers. So help us understand if you intend to change the trajectory anytime soon. I think for the first half it was around that 5% level, so it seems to be inching higher, but still a little lag behind the peers, at least select peers, not all of them. How do you intend to outperform the industry?
So margin for our industry, looking at margin percentage per se may not be the right indicator.
Okay.
And I'll tell you the reason why.
Okay.
For example, if I sell a GLR vehicle, say about a crore, the gross margin that I will get is maybe about 10 lakhs.
Right.
When we convert it to a percentage, it's only 10%.
Okay.
So it's skewed towards the sales revenue, so to say, because as you said, we said now 80% of our revenue is from sales. But if it comes to the bottom line, this 15% of service is what actually adds to our bottom line.
Correct.
So in that way, percentage of margin may not be the right way of looking at it. Probably, finally, what they call the mother of all ratios, the return on capital employed or the return on equity may be a better ratio to look at. So at the return of equity or return on capital employed, I mean, the only other listed company which we can talk about is Landmark. We kind of fare better than what they are. So as we speak, we are a return on net worth is about 18. I mean, was about 18% in March 23, which has improved to more than 10% for 6 months in September.
Okay.
So return on capital employed is also hovering around 18%.
Right.
I mean, for the last 1.5 years, 2.5 years, our net worth would have increased by nearly 1.5 times, from about 250 crores to nearly over 384 crores. So, and as mentioned earlier, our focus on services. For example, the last 3 years, we have put in nearly about 50 service centers, another about 30 inorganic service centers, nearly 80 service centers we have put in. All this is going to play out and improve our EBITDA and PAT margins as we go forward.
First half also in terms of comparison, if you...
Yeah, Landmark comparison, I can quote some figures with Landmark.
I mean, if I can,
Sure.
interrupt you guys before you quote in. From the little I understand, help me understand this better. Return on capital employed 3-year moving average is at 19%. You gave me a figure of 18%. I've just averaged it out to 19% for convenience. It is at 24% for SAI services. It is at 20% for VST. So though I understand there is a bit of scalability difference, Landmark Cars is at 22%. Do you intend to catch that up anytime soon?
Definitely. As I said, for the last 3 years trajectory that I gave you, the EBITDA margins for service 3 years back was about 13%, which in FY23 has become 18%. So service alone, the EBITDA margins improved from a 13% to an 18%. And the fact that I mentioned earlier, our focus is on servicing, wherein we're putting in more service plants, which will help in the entire company to improve its EBITDA margins. And in effect, finally, the ROCE and ROE.
Point when taking, actually, services is 15% of your overall revenue right now.
Yep.
So you intend to scale that up to how much for that incremental levers to kick in for the organization?
I can tell you of the past, as I mentioned, 2-3 years back it was 10 or 11%.
Okay.
And now it's about last 3 years become 15%.
And we've been growing at around 25%.
At the same pace are you looking at?
No, it'll improve even further. As I said, the last 3 years we put in nearly 80 service centers. Definitely it'll be much higher than that growth which we showed in the last 3 years.
So a double-digit margin is something which is too optimistic, aggressively optimistic, or achievable by the company?
I guess achievable.
By when?
Not say put a name, a figure or a year to it, but I'm saying the entire endeavor, if you've seen the last 3 years, how we have focused on it, hopefully that holds good.
Okay, I'm not going to push you more on this one for the limitations that we work with.
But I think John can share the FY24 first half figures, since that is already there in the RHP.
Yeah, so last year FY23 we ended up with a PAT of 64 crores. Year before that it was 34 crores. And in September 23 we are at 40 crores.
And you can talk
compared to a Landmark which is about 28 crores.
Okay, so help me understand this. 34 crore first half FY 2022.
No, full year was 34 crores.
34. And the first half of FY 23
is 40.
becomes...
FY 24 is 40 crores.
Okay, it's 40 crores.
Yeah.
Okay, and this first half is how much?
No, this first half is 40 crores. Last year full year was 64.
Okay.
The previous year full year was 33.
Fair. Okay, point well taken. It looks like a decent trajectory there.
Yeah, and just to compare with Landmark, since you were mentioning about our competitors, first half, as I said, we ended up with 40 crore PAT. Landmark ended up with a 28 crore PAT.
Okay.
And in December, Landmark figures out, they're I think about 47 or 48 crore PAT.
So what really is helping you to outperform your peers like Landmark? One is the service focus and the scaling up capacity.
Absolutely.
Anything else that I'm missing out, gentlemen?
The inorganic growth also, that's also is playing out.
Okay. That's fair point taken there. Also, what explains the negative cash flows for the first 6 months? Help us understand more about that. What can be expected on that one, and when can we see that turnaround from the operating activities at least being positive?
Sure. So if we look at the cash flow from operations before working capital changes, it's positive.
Okay.
In fact, the percentage has improved compared to last year. As cash flow from operations before working capital, last year was 4.6%. This year actually it's 4.7%. Actually we have improved. The reason why working capital, as we were discussing, working capital is based on the inventory levels that we carry. An inventory level depends on the customer requirements of future. So, and it kind of varies depending on what seasonality that you're in. So in a September, which is a festival season, or some other particular months, it depends on what's the sale that is going to happen next few months. So if we remove the working capital requirements, prior to that, it's positive actually.
Okay.
And also in terms of working capital, so if you look at last year, our turnover was about 5,000 crores. Our working capital, average working capital through the year was about 400 crores. So it's at 12 turns in terms of it. So about 25 to 30 days of stock at any given point of time. And this, over the last couple of decades, has been in the same ratios. So there's not much of a change there at present.
Okay. Your revenue stream is diversified. How are you seeing demands from across categories? I think I've already asked this, but dwell a little more on that and tell us at this time, which is that segment which is perhaps mustering in more demand, which is that geography which is seeing that incremental demand. Tell us more about that.
So in terms of, if you look at the passenger vehicle market, obviously the SUVs and these slightly in terms of premium, if you look at even Maruti in terms of our Nexa growth vis-a-vis our Arena growth. So if you look at Nexa, last year, that was FY23, the full year we did about 5,500 vehicles of Nexa. This year, first half, we have done close to 5,000 vehicles. So in terms of the premiumization that's happened within the Maruti segment has also helped us in terms of achieving larger numbers per se. If you look at commercial vehicles is going through a sort of slowdown per se here. But if you look at small commercial vehicles, which is a large part of our portfolio, approximately 60 to 70%, the demand is still there. In terms of heavy commercial vehicles, it's skewed towards construction segment, the demand. Electric two-wheelers, till the FAME 2 and FAME 3 subsidy becomes a little more clear, I think the demand would be a bit tepid.
Okay.
Yeah.
So that's in the second half of this financial year. So
post-March only we will know.
Okay, I mean, it's technically, we're just approaching towards the fag, and that's true. But any kind of margin moderation before the final uptick happens? Because we are looking at an incremental pie coming in from services, and that perhaps could be kick-started in the next financial year. So just to lay out the projections pretty clear, if you're comfortable with that.
No,
yeah, as I mentioned, last year we ended up with 4.8 for the company, including sales service. And September we are at 5.1.
Okay.
So that gives you an indication of how we are moving forward.
Okay, point well taken. Okay, let's understand. Right now, 96% comes from Kerala, Tamil Nadu, and Karnataka. This is as of the first half of the financial year. Any plans to diversify that in the coming future?
So as I said, in terms of we're looking at high growth markets and in terms of where the population is already there.
Right.
So Maharashtra, which we've just entered, so deeper
Gujarat.
into Maharashtra, deeper into Karnataka. We've just got the LOI for Maruti in Karnataka, in Bangalore. So we should be opening out hopefully by March or April. So those are the areas that we would focus on. And the other growth markets, Gujarat, NCR region, Andhra and Telangana.
Just to add to what Naveen said, there are very few dealers in India today which has got operations in more than 4 to 5 states and having more than 100 outlets. We are one of them. It is a fragmented dealership setup today, which we feel is going to get consolidated, and that's what we would like to work on.
So just to add to what John said, the pie in India, so 4 million vehicles are being sold in India. Out of that, 41% is Maruti, about 1.6, 1.7, 1.8 million vehicles. Top 10 dealers of Maruti put together is only about 350,000 vehicles in terms of overall for the annual. So the runway is huge. So if you look at a comparable market where consolidation has already happened, both US and China, where we studied markets, one of the largest dealers of US already does 350,000 vehicles annually. Here the top 10 dealers do 350,000. Their market size is about 15.5 million vehicles. We are today at 4 million vehicles. But given the way the economy is going for India and saying that this is the decade for India, then one of the largest industries is the automobile industry. And we would see a reasonable CAGR for growth. And that's a runway that we're betting on.
All right, gentlemen, we're just going to leave it at that.
Thank you.
And thank you so much for taking out the time. That was the management of the company. Pretty optimistic when it comes to the tailwinds of the industry, be the capability in which they can grow up and scale up, their inorganic plans, and also the fine edge that they're getting over the peers. But with this, it's a wrap. Thank you so much for tuning in.